Hey everyone, I am here with the notorious Greg Foss. He's a whiz at math, bonds, and now Bitcoin. Greg, tell us about your background as a bond trader, your history, and how it's led you to finding Bitcoin.
Well, sure. Thanks for having me. I'm not sure I'm notorious, but I guess by...
You're getting there.
Thanks. I guess by longevity, I've spent 35 years in a chair. I like to call it a risk chair, where I've managed risk on behalf of. I started managing risk on behalf of financial institutions, and then I moved to the hedge fund side, managing money for clients, so high net worth individuals and institutions like pension funds. And my career spanned 4 different financial crises. I got my start in 1988 when the Latin American debt crisis was full force. And then I lived through 1998, which was the long-term capital management, which was, quite a clown show because they had a Nobel Prize winning economist on staff of long-term capital management. There might have been 2 actually, and they levered themselves 100 to 1 and were selling insurance to Wall Street as a hedge fund that had no ability to weather even a 1% decline in their portfolio because they're 100 to 1 levered. Yet their portfolio declined something like 40%, 40, due to the insurance products they were selling to Wall Street, and Wall Street just keep continuing to buy these insurance products, and the price of those insurance products goes higher. And long-term capital management had sold them all at lower levels, up. And then they had to get bailed out. And then so 2008, 2009 was the real deal. That was a great financial crisis. And the world was ending then, Julian. It's important to understand that, all of these successive financial crises, they're built on leverage. They never get solved. Losses get socialized. So much like in the case of long-term capital management, they got a Fed bailout. And then in 2008, 2009, Wall Street got another Fed bailout. And, you mentioned my love of math. I'm not that good at math. I am an engineer as in undergrad, but, nothing special. You don't need of calculus. You don't need differential equations to understand the reality. Continuing to kick the can down the road increases the debt burden, and then it becomes impossible to escape that debt spiral. So my history has been predominantly, as a market practitioner, and I like to call it the Fiat Ponzi. I have lived 30 plus years of the Fiat Ponzi, and there is no solution. The only solution is continued fiat debasing, continued monetary expansion, and as an investor, as a risk manager, you need to protect yourself against that.
And so where has Bitcoin come into it for you? How did you discover Bitcoin, and why does it kind of fit into this thing that you could possibly use as like a hedge for debasement of fiat currencies?
So, I like to say that in 1988, when I first got my start, after I did engineering in undergrad, and then I went to a business program in the USA, and I came back to Canada, and I was working for Canada's largest financial institution, the Royal Bank of Canada, and I was working directly for the CFO. And one of my first projects was the aforementioned Latin American debt crisis. And it wasn't very difficult to figure out that the Royal Bank of Canada was insolvent, which is a polite way of saying it was on its way to bankruptcy, because the loans that it had made to Latin American countries were trading at a discount of 75% to the value of the loans they had made. And if you wrote that, if you call it a discount, if you wrote that loss, mark to market loss, off against the book value of equity of the Royal Bank, there was negative book value of equity of the Royal Bank. And it was pretty scary. So in 1988, I had just come out of school, and I'm like, oh my God, I just spent 8 years or 6 years in school to realize that our banking system is built on sand. Nobody understands the Fiat Ponzi as it exists because banks are extremely levered to their risk absorbing capital. And then I mentioned the other successive financial crises. So you could argue I was looking for Bitcoin or a solution like Bitcoin since 1988 when I started to question the Fiat Ponzi. Now, I did go to the CFO and I said, we have a big problem. And he said, I know, don't tell anybody. And that's pretty scary, right? Where Canadians have their money deposited in this institution, and the defense against educating people about the true risk that they're exposed to is not to tell them, and then everybody just expects the bank to be too big to fail and the government would bail the bank out. And that's somewhat true, but there's no difference between socializing losses in commercial banks, socializing losses in investment banks or Wall Street. And so I was introduced to Bitcoin in 2016, and like everybody, I believed what I had read in the newspapers. And luckily I did some research because I thought Bitcoin would be much like the Ponzi that the newspapers made it out to be. And luckily for me, I did some research because as an engineer, I started going through the characteristics of Bitcoin. Okay, there's only 21 million of them. Okay, that's interesting. It's decentralized. There's no party that controls this ledger, distributed ledger. Oh, that's pretty cool. It's defended by math and code. I like that. It's transferable, portable. It is a solution. Now let me see how this thing works. And so I went to the Bitcoin blockchain and I watched the blockchain in action. And as an engineer, I'm quite visual. And I was just, oh my God, this thing is a living, breathing ecosystem of transferring value from address to address. And you can watch it in real time, and you can watch the hashes go across and formulate the blocks that are mined every 10 minutes. And I just said, oh my God, this is a thing of beauty. And so I was asked to Montreal to invest in a company but it was going to be a company that brought Canada's first closed-end Bitcoin fund to the Toronto Stock Exchange. And we were successful at doing that. And I'm proud to be a founding shareholder of that effort. The company was called...
That was 3IQ, right?
That is correct, 3IQ. Now, I'm no longer a shareholder of 3IQ. I will tell you that I'm proud of their Bitcoin efforts, but not proud of their shitcoin efforts. So there was a divergence of views there. But leaving that all aside, Canada's closed-end Bitcoin fund actually became a precursor to a spot ETF in Canada, which leads the United States, okay? And for that reason, proud to have been a part of the efforts. It allows Canadians to buy Bitcoin in their RRSP and other tax-deferred investment. Now, there's other funds in Canada that do that as well. Purpose Bitcoin Fund, same thing. You can buy Bitcoin in your RRSP and get essentially a tax benefit, which means if you wanted to buy $10 of Bitcoin, you actually get a tax credit for 50% of that. So you're effectively able to buy $15 of Bitcoin on an after-tax basis, which hey, I don't mind when the government augments my investment decisions by giving me a tax break. So, as an aside, I found Bitcoin in 2016. I've sort of become more of a Bitcoin maximalist. I didn't see eye to eye with the 3IQ management, etc. I moved my interest in Bitcoin, the ETF or the asset management side, to the power business, and I'm involved in a power business now that mines Bitcoin. We have 4 power plants in Ontario. So, everything moves. It was a fluid process, but happy to be involved in Bitcoin. More focused on the power and energy side of the Bitcoin equation right now. And never been more committed and never had higher conviction that Bitcoin is the only solution to the Fiat Ponzi that we are living, because the final crisis that I lived through was the government response to COVID, which was an absolute clown show. So there is no escape from this. You need to have a store of value that in the form of Bitcoin, better than gold, for all reasons that include transferability, verifiability, portability, 21 million hard cap. Gold is not fixed supply. If the price of gold was to double, the 2% annual growth rate of gold would absolutely increase. The supply would, because more gold miners would go out and find reserves that were profitable to mine. But if the price of Bitcoin doubles, we know the supply with 100% certainty. It does not change according to price. So I love everything about Bitcoin. I believe everybody needs to own a portion of Bitcoin in their portfolios. And I'm a Bitcoin maxi, but I don't say you cannot own other assets. Like, I've always been a risk manager where I've never been 100% in one trade or one specific asset. So, I'm a little bit different from some of those other maxis, but that being said, no less convicted that Bitcoin solves a lot of the ills of the fiat system.
I think there's a lot of people who have probably similar journeys to you, but what they do instead is they just invest in Bitcoin and they ride off into the sunset. You've gone out of your way, you're headlining conferences, you're flying around the country doing these meetups, you're launching an education program. The simple question is, why do you care so much to educate people about this?
Well, thanks for the question. Yeah, you know what? So I'm probably a type A plus personality. It's very hard to ride off into the sunset after you've spent 30 years in a competition. Essentially, the way I described my my former job was, it's like having a professional sporting event every day. You know the score at the end of the day. You're nervous, like in a regular sporting event, and you can't turn that off because then you sort of lose your identity and your internal drive. So I found Bitcoin at a good time in my life. It was time for me to retire from the risk management. The pressure of that had built up over time. But the answer is, why am I doing it? A combination of that, as well as the fact that I have 3 children, and I feel that I have some experience to be able to offer and experience to lean on that many people don't. They have never sat in a risk chair forgive this, but when you're sitting in the risk chair and your sphincter is clenched so tight because you're so friggin' nervous about potentially the world unraveling. I'm talking about 2008, 2009. That feeling, you can't learn that in school. They don't teach it to you in a textbook, because if they did, you'd be like, well, this is ridiculous. This is because of the Fiat Ponzi that these financial crises occur on a regular basis. So, well, let's look at the positives. I'm extremely happy to have met other Bitcoiners within this community. So that's what keeps me going. For example, Jeff Booth, two Vancouver, great Vancouver people. Jeff Booth on a global stage is one of the most well-respected Bitcoiners globally. I never would have met you guys if I didn't, go out of my way to try and learn. Yeah. Why do I meet a guy like Jeff Booth? Well, damn, I want to learn. And then you go out of your way to meet other people and realize that you have similar goals. And again, I'm somewhat concerned and I'll be more honest. I'm very concerned about the future for my kids as well as our kids as a group because I don't think the politicians understand the mathematics on the one hand. But if they actually do understand the mathematics, I know Trudeau doesn't because he admits he's very poor at math. But my answer to that is, well, perhaps you shouldn't be the CEO of a country then if you're not very good at math because, if you're not good, if your eyesight is very poor, you probably shouldn't become a surgeon either. Like there's some silliness that exists in the world that it's hard for me to put up with it. So I try and speak out. Sometimes it gets me into trouble. But more often than not, I meet good people who have aligned incentives, and it's something that I'm passionate about.
One of the things that you say quite often is that credit is the dog and equities are the tail. And that too many people are focused on what the stock market's doing on a given basis and not looking at the credit market. I want to dive into that, but maybe for those who don't know about bonds and the role they play in the financial markets, what are they and what is the scope and why should we be paying attention to the bond market?
Okay, great question. Well, let's start with the fact that the bond markets are far bigger. The credit and fixed income bond markets are far larger than the equity markets. About 4-1 in terms of the relative size of the two markets. Couple that with the fact that bonds have a prior claim in any capital structure. So you have bonds that rank senior to the equity. And if the bonds are, as an entire asset class, 4 times as large as the equity, and these guys up here aren't happy, well, these guys down here flung around like a rag doll because in certain cases you can actually use the equity as a hedge against your bond position. In other words, if the bonds are not worth 100 cents on the dollar, in the event of a restructuring, the equity is worth 0. All right, that is Finance 101. And that reality, that law of finance, if you will, indicates that you better understand what's going on in the credit markets if you're going to take a position in the subordinate claim, the equity. So, I got my start in junk bonds, in high yield bonds, the pejorative junk bonds. Which is a dumb pejorative because it's not. It never considers price. There's got to be a price for any bond that makes the risk return balance. But that being said, if you're going to call it a junk bond, apples to apples, you have to call the equity super junk equity. And the reality is, last time I did a study, over 70% of the market cap of the Toronto Stock Exchange, for example, would be a junk bond, not including the financial institutions that actually are junk as well. They're just not rated as junk because the rating agencies believe that they're too big to fail and therefore benefit from the implied safety net. But the biggest junk bond managers in the world are commercial banks because the commercial bank loan portfolios are by and large junk. So the crazy thing is people don't understand the priority of claim, and sometimes they'll own the equity of a company and not the bonds because the bonds are junk. Well, you're a Canadian. Did you know that Ted Rogers of Rogers Communications, famous cable and wireless company in Canada, was once the largest junk bond borrower in the world. Not just in Canada, in the entire world. But all Canadians owned the equity because it was in the TSX 60, but they wouldn't own the bonds because the bonds were junk. What a bunch of buffoons, okay? These risk managers should have been fired on the spot. But, you know, old habits die hard. Oh, they say it's a junk bond or non-investment grade. Therefore, I can't own it. Very hard for me to stomach. Indicates a lack of understanding of risk versus return. Anyway, you have to fight these battles over time. The battles that I experienced in the high yield market are being revisited in the Bitcoin asset class because there's true lack of understanding of what Bitcoin is amongst institutional money managers. So it takes some time. You have to fight your battles. Sometimes it's really frustrating because it's like talking to someone who's dumb as a fence post, right? Because there's lots of really dumb asset managers out there. But over time, you know, you see progress. And when I started trading high yield bonds back in the mid-90s, there was only one client in Canada. It was actually a Vancouver-based client called Dean's Knight Capital Management. Doug Knight, good friend of mine still. He was Canada's first high-yield bond manager. All of the other bond managers lived in the United States. And now every single asset manager in Canada has a high-yield bond sleeve because he realized, wow, it was silly that I owned the equity of these companies, but I wouldn't own the bonds because the bonds were junk. I might as well take what I know about the equity and earn a return on the bonds that were better than other returns I could get in other assets. So over time, this comes, it's part of an efficient market, Julian, and then, you know, 30 years later, all of a sudden, wow, it's like commonplace that everybody owns high yield bonds. Same thing's going to happen with Bitcoin.
One thing I've always had such a hard time wrapping my head around is this mandate that a lot of funds have to buy bonds in the first place. Like there's the whole idea of the 60-40 portfolio, but a lot of these funds, they have to put a certain allocation into bonds. Who makes those decisions?
Yeah, they don't.
Why do they have that mandate?
Well, great question. Okay. Yeah, let's be clear. They don't have to. It's set by an investment policy committee that can change those mandates over time. Okay? Now, it's traditional. If you talk about, you know, the traditional balanced fund, it was 60% equities and 40% bonds. A bond is a fixed contract. When you buy a bond and it's issued at what's called par or parity, 100 cents on the dollar, there's a coupon associated with that bond that is a contractual return. In other words, if they don't make that interest payment, that is termed a default, and that's when you have to restructure the debt, and that's when the equity, the subordinate equity, gets, you know, flushed. But that contract is fixed in both directions. Let's say the company starts, or even the country starts doing really, really well, and the coupon that you initially charged on that contract was, let's say for a number, 10% coupon, and a couple of years down the road, the riskiness of that entity has decreased from 10% type of coupon to a 7% requirement. Well, the price of that bond actually goes up in order to adjust the yield to maturity. So it goes up through 100 cents to trade, let's say, at 110 cents on the dollar. The increased price of the bond takes away from the returns on the coupon so that 10% goes back down to 7%, and everything matches up in terms of a return for the risk. But the truth is, a bond will never double in price like an equity. So if the company starts doing really well, any excess cash flows required to pay the interest, that accrues to the equity holder. And this is why you have equities that can double, triple. Bonds don't double and triple, but the flip side is they have a prior claim. Again, the equity, hold on one sec. Shawnee, I'll call you back, bud. So basically, that's my former partner from 3IQ. There you go, small world. So anyway, the equities can double and triple, but they can also go to zero before the bond goes to zero. In other words, again, the priority claim. So all of these are different things that impact a capital allocation policy. And conversely, in line with that, a 60-40 weighting for equities versus bonds. A lot of the bonds that people hold are government bonds. And those government bonds, while they don't have publicly traded equity as a subordinate claim, they do have equity, because you could argue that the assets of a country should outweigh, and I just went on pause here. Can you? Oh yeah, okay. Should outweigh the liability, so that there is positive equity left in a country per se. But all of this, Julian, all of this leads to a risk versus return calculation that balances how much equity versus how much bonds you should own in a portfolio, that is set by an investment policy committee. And it doesn't change month by month. It doesn't even change year by year. This is a long-term process studied by pension consultants to match risk versus return, assets and liabilities within a pension to the benefits, the plan benefits for the pension, for example. So lots of things go into this, into these decisions. But yeah, there's very few pension funds that will ever own 0% bonds, even though there are times, just like the year that we just went through, where bonds were a horrible investment. And, you know, they don't change that.
Like, they're all, like, most of them are negative real yield, right?
Right now,
now
it's only, well, so let's be careful, because a real yield is calculated by taking the yield on the bond, and that's called a nominal yield, and then subtracting the rate of inflation, which, you know, in the case of the United States is 9%. Well, there's not, even the high yield bond market yields less than 9%. So the high yield bond market as a whole yields 8.4%. And you subtract inflation from there, you're 8.4 minus 9, you're at a negative real yield. The difference is, though, they don't think that inflation will last over the period of the entire high yield bond, for example. Like, they think that inflation is going to come down. Now, all of these things are, you know, are fluid, and these calculations get repriced on a daily basis. That's why bond prices change on a daily basis, like equity prices change. As more information comes to the fold, people make their decision as to how to balance their portfolios.
When I look at a bunch of, like, sovereign nations, like you got the U.S., Canada, let's just say the European Union, and Japan, it seems like only in the West are we seriously trying to fight inflation with raising rates. Japan's on this whole other thing with the easing. But just to focus on, like, the ECB, it seems like they're way, way behind the curve on fighting inflation. How are they getting away with it over there? I think they just did their first rate raise, but they were already in negative territory. Why are they so behind the U.S. in fighting inflation, you think?
I mean, it's really disconcerting, the lack of financial intelligence that Lagarde has. And then she laughs at herself, including other central bankers that laugh at themselves when Powell said, I think we're just beginning to understand how little we understand about inflation. Like, these guys are horrible risk managers. And so, on the one hand, in the case of the ECB, they had negative central bank rates, which brought the bond market to negative nominal yields as well, which is ridiculous. A bond then is not even an asset;
you got to pay. You got to pay them, right?
You lend them $100 and you get $97 back. Like, that's a really great investment, right? But that's the reality of the clown show over there. Europe is a dog's breakfast, okay? You have one country, Germany, holding together all of these other countries from a debt metrics perspective. The ECB, we talked about this in the introduction or before we went live. You talked about their fragmentation policy and buying of the bonds of Italy to defend the Italian yield. So when you buy the bonds of Italy, you hold their price and their yield doesn't spike. All of this is nothing more than manipulation of risk. How would you call it? A risk hurdle. The manipulation of these rates is destroying capitalism because there's no open market pricing mechanism for risk. But that's Europe for you, right? Like Europe has been for hundreds of years has been they've borrowed from the future of their children. We saw the crisis in 2012, the Greek crisis. They called it the pigs. Portugal, Italy, Greece, and Spain. They got rescued by Germany, but the question becomes, how long are the German people going to be willing to pay their hard-earned savings to help out their southern neighbors who, for a long time haven't really been that hard-working? They've chosen to live on the government dole, right? So that's Europe. That's a mess. And now in North America, the world's most important central bank, the Fed, they have a lawyer running the show who made that statement about how little he understands about inflation. Well, he's swinging the economy. He's like a clown car bouncing off the rails of the of each side of the road. And then you have Japan, who's got totally on their own for the last 20 years, where Japan has been quantitative easing infinity, yield curve control. The Japanese yen has been crushed. This is all reasons why you need to own Bitcoin, because this is part of the Fiat ponzi where they manipulate rates, they cause inflation, monetary inflation, plus now price inflation. It's not sustainable. Something is going to break, and when things break, a lot of people are hurt. And the successive financial crises just get worse because the debt burden that the world has built up is larger and larger just due to the organic growth of the debt due to the coupon, this contract that they have to pay on the debt. So, look, each central bank has their own. It's not a mandate. In the case of the Fed, they have a dual mandate, and some would argue a third leg of the stool. Control inflation, full employment, financial stability. Those are the triple mandate of the Fed. European Central Bank, a little bit different, but the financial stability mechanism isn't just one country. Now it's a group of countries in the European Union. So it becomes like herding cats. It becomes harder. So it's a mess, Julian. Again, this is why you have to own insurance on this messy situation.
Yeah, when I heard that whole deal with the defragmentation or whatever they're calling it there, the first thing that came to mind is like, this is kind of, I think, why the UK pushed for Brexit. Like, they don't want to be a part of the mess that's going on in the EU. And like what you're saying about Germany, like, if I'm a German citizen and I'm learning about this stuff, I'm finding that I'm bailing out other countries through my productivity. Like, it feels like if they let this go out of control, it could end up really severing the EU.
Well, not only that, I mean, there could be a social unrest as well, right? I mean,
Yeah.
as a taxpayer in Germany, are you happy that your hard-earned taxes are going to be are used to bail out the less hardworking neighbors?
One of the things that you've said a few times is that Canada is in a much worse position to do a debt default than the US. And I think you might have changed your view on this, but I think at one point you said it was probably going to be the first fiat in the G7 countries to collapse. What do you see in Canada's debt crisis that makes it a little bit different than the US?
Well, first of all, you have to go and see. Okay, let's talk size of the economies. I mean, the United States economy is 10 times the size of Canada, and consequently has much more diversification of industry and much more ability to weather a storm in a certain sector than Canada. And the reality is Canada as a country is smaller than California as a state in terms of the size of the economy. I mean, that's mind-boggling, but true. But what does Canada not have? Canada does not have a European central bank to bail it out. It has a small economy. It's still a G7 economy, so one of the top economies in the world. But it's, again, less size than California. It's bigger than Portugal, Italy, and Spain individually, but they have the European Central Bank backing them. Canada doesn't have that. And then if you look at open market default insurance premiums between the various countries, you'll see that Canada is far riskier, meaning the insurance premium is higher to insure Canada or debt on Canada against default than it is in the United States. So that is basically nothing more than going to an open market evaluation of the risks of default of the various countries. So, I can say all of this, but the easiest thing I can do is point to the actual rates that are being charged on insurance, and you'll see that Canada is far riskier than the USA, as it should be. Now, as far as the first country in the world to I shouldn't say first country in the world, the first G7 nation to default, I'm not around there saying it's going to happen tomorrow. And a lot of this is speculation. Some people think the yen or Japan will be the first G7 country to default. All of this is nothing more than an evaluation of the relative risks, and you have to be prepared for that. Canada has some good things going for it. It has a fairly educated workforce. It's got a natural resource wealth, but it also has a prime minister who's a buffoon. So you don't invest in a company whose CEO is a buffoon. The political posturing of a prime minister who says stuff like the budget will balance itself. I mean, what is he, a 2-year-old who's lived on his father's credit card his whole... Oh, yeah, actually, that is what he is. He's lived on his daddy's credit card his whole life. He doesn't understand finance. He admits he's poor at math. Well, all of these check boxes add up to, I'm a little concerned that the person who's balancing the budget doesn't know how to balance a budget. And when you don't balance a budget for long enough, you go into financial distress. Doesn't matter if you're a household or a corporation or a country, it's exactly the same outcome.
Well, one of the things that I found has been really interesting this year, we've had like a huge correction in tech, but bonds have also been falling as well. The Fed's raising rates, but something I've noticed in July is the 10-year yield's actually been dropping for a solid month, even though the Fed's been saying, oh yeah, no, we're probably going to do it, another 75 basis point raise. Is this a market misallocation, or do you think that the market for bonds is kind of calling the Fed's bluff on how far they're going to really take rate raises?
Absolutely. Yeah, I mean, but on the one hand, they're calling the bluff, but on the other hand, they have to be cognizant of the fact that inflation is what inflation is. So you can try and call a bluff, but it doesn't really mean that it makes sense to buy something. In the case of the US 10-year, it topped out at around 3.5%, and then it's now down under 3%. So as you mentioned, the yield's coming back down. But if inflation's still at 9%, like, who's the idiot? You're buying something at 3.5% yield, and you're going to lose 5.5% on a real basis because inflation is 9%. So, like, you can, all of this is part of the open market to and froing of a pricing mechanism. But don't get too smart by a half, okay? You're calling the Fed's bluff, but the Fed hasn't solved inflation. You might think inflation is going to come down, but until it does, you got to be real careful about calling somebody's bluff and everything like that. So, look, an open market, this is when I started trading bonds in 1988, interest rates were double digits, all right? U.S. 10-year rates were double digits. Now they've come down and they bottomed out at under 1%, and now they've come up to 3.5%, and now it's sort of stabilizing around 3%. This is ridiculous because inflation today is just as bad as it was in 1988 when bond yields were 12%, not 3%. So this is, again, people have, they become so complacent with yields that they're trying to protect their home turf. It's you see this all the time. You're protecting your losing position. Well, if you want to really earn negative 5.5%, that's not a great return, but that's what you're saying if inflation doesn't come down. If inflation does come down, which is probably likely, but it doesn't mean it goes to zero. It may not even go under 3%, which means the best you can hope for is a wash on a real basis. Wow. I mean, it's just a mess. Julian, it's a mess. It's comical. Having spent my entire life in that market, I shake my head. I mean, what a bunch of juveniles, right? What a bunch of rookies. But I'm not going to change it. It's a massive market. It is what it is. Let's see how it turns out.
Have you read Arthur Hayes' articles on kind of the different bond markets around the world?
So Arthur Hayes is...
He was like the founder of BitMEX.
Yeah, okay, so I have seen some of his stuff. I haven't read the articles per se.
He was a bond trader, I think, before he started the exchange. But he had this kind of interesting thesis, and I'll do my best to summarize it, and then maybe you can let me know what you think about it. It was this idea that the U.S. could kind of kill two birds with one stone, and that they're not going to be lowering the rates or not. They don't want to be seen as not fighting inflation, but it looks increasingly like they're going to have to come to the aid of Europe and Japan, because Japan's got, their yield curve control is, not working super well after hours, and then the EU is just fighting runaway inflation. And so there's this idea that the U.S. central bank might start printing money to buy foreign bonds, and this idea was actually floated by Bernanke back in 2008.
No, yeah, that's true. Yeah, that's right.
Do you think this is a possibility?
100%. I mean, they'll say QE. We're doing quantitative tightening domestically, but we're doing QE for other nations. How long until the United States population says, is it really smart for me to be buying Japanese bonds at a 0.25% yield because that's where they want to lock their 10-year rate? That's what their yield curve control is. So as an American, do you want to own Japanese bonds at a 0.25% yield to help the Japanese economy out? Heck no. Like, come on. So you can do this stuff, and it's in the efforts of maintaining global financial stability and all this, but eventually these things break. It's like squishing one part of the balloon, and all of a sudden another part of the balloon is under enormous stress. So there's no question that is one of the potential tools. But the question then becomes, how long until the population calls the Fed's bluff and says, you guys are never going to reduce your balance sheet? Like, don't forget the size of the balance sheet when Bernanke made this statement the first time was 1/30th the size of the Fed's balance sheet right now. It's a totally different ball game now. And so Bernanke, there's lots of people that blame Greenspan and then blame Bernanke and are going to blame Yellen and then Jerome Powell. They all are made of the same cloth. They cannot stop printing money. It is mathematically certain. They have to print money, which means it's mathematically certain that the value of the monetary unit decreases. So your house is not going up in value, people. It just takes more of this debasing monetary unit to buy the same house. Now, there will be fluctuations over time in the value of your house, but generally, the price of your house has been from the bottom left to the top right because the unit of account has been debased.
The denominator.
This is why you need Bitcoin. Correct.
One of the, yeah, I mean, it's. I know you've done some math. Maybe we can dive into that in a bit about how you reached like a $2 million price target. But one of the things you say is you're never going to put a timeline on it because it's crazy to try and predict when all these things happen or when the fiat Ponzi collapses. I think my concern when I just think of like my generation and how long this madness can continue is that the U.S. seems like the least dirty sheet in the laundry. And they're getting, I think that as more and more of these countries, like we saw Sri Lanka default on their debt, the more that these events occur, the longer I think that this fiat Ponzi could possibly play out, that more than any of us predict. You don't think so?
No, look, it's been going for 30 years. If you look at history, how often, when a currency generally loses global reserve status is after about 100 years. The United States is right up around 105 years, okay? That doesn't mean it's going to fail tomorrow. What it does mean is that the system as it exists right now cannot continue or else everything's going to blow up. So the U.S. probably is the most likely fiat to survive until the end, but fiats default all the time. As you said, dirty sheet in the laundry. I like to say the USA is the best crack house on a crack street. Like, who the fuck cares? Sorry about my swearing, but like, call it what it is, people. Yes, we don't want it to end tomorrow, but the mathematics of it indicate that it is spiraling and accelerating out of control. So don't wait till the last minute. Yes, it could go for a lot longer, but risk happens fast, and you don't ever know what snowflake causes the avalanche, okay? And that's a Jeff Booth term. You don't know what snowflake causes the avalanche. Risk happens fast, slowly then suddenly. You don't go and buy your fire insurance as your porch is on fire, okay? We can see the firestorm is approaching. Bitcoin is the insurance. Buy your insurance. You don't want the world to end tomorrow, but the chance of it happening is increasing daily, just pure math, and then it gets accelerated or accentuated because you have horrible leadership that pour gasoline on the fire that's coming at coming at your house.
So what do you think about, so what's the next step then for the countries that have defaulted? I don't know the history of, really what happens to a country when they default, except for some of the cases where the IMF just comes and bails them out. But you got countries like Sri Lanka.
Well, the IMF doesn't bail them out. I mean, the bondholders take a haircut. Argentina has failed, a G20 country, has failed 4 times in my career. Well, each time, the bondholders, the bonds that were trading at 100 cents on the dollar, went down to 25 cents on the dollar, and there were people that sold them at 25 cents on the dollar. So guess what? They locked in a loss of 75 cents on the dollar. Well, the country gets enough people to lose 75 cents on the dollar on their debt, and all of a sudden their $400 of debt goes down to $100 of debt, and then they start the whole game over again. So who's the fool in the room? Not the issuing country. It's the people buying the bonds that are the fools.
I'm just trying to figure out is like, this stuff happens all the time, and the countries just they still manage to go on,
Well, because you have people that are willing to lend them money again, Julian. Some people don't learn.
So when does that stop, though? Like, if these countries are so obviously a risk, like eventually, people have got to just smarten up and say, no way, like, I'm not going to lend to Sri Lanka.
Correct. It stops. You don't know when, but you just said this could go longer than we thought, and now you're saying, when does it stop? Like, you can't suck and blow at the same time. You got to take a side. You got to worry that something is going to happen. I don't know when it's going to happen. I'm a proud Canadian. I don't want Canada to fail. But I'll just say that there's people that are doing their best to make it happen. And they're making it happen in large part because they don't understand the consequences. They've never been a bondholder. They've never lent money. So all of these things are part of the thesis that I have, that you need to own Bitcoin as insurance. It's credit insurance. It's insurance against this potential collapse or contagion within the financial systems.
My thing is, I think the countries that collapse, they're getting fewer and fewer lending options. And it gives the party that does have the money, that's willing to take the risk, like the IMF, an insane amount of power to go in and kind of institute whatever rules they want in these third world countries, which kind of sucks. But like the whole thing with Sri Lanka was, yeah.
Yes and no, but the IMF is funded by the United States by and large. So, look, I mean, yeah, it sort of sucks, but, eventually this changes. And El Salvador's trying to do some changes, and the IMF is U.S. money, and maybe over time U.S. citizens say enough's enough. Why are we going to continue to fund these basket cases? Sort of like Germany is saying to the southern neighbors in Europe, they might. So, I just can't tell you when. And I would just say the chances of it happening are increasing on a daily basis, but it doesn't mean it is inevitable. It's inevitable over time. The question is that hundreds of years? Is it tens of years? You don't know, and that's why you have to protect yourself against it.
We talked earlier about, or you mentioned, shit coins. Some of these people going down the path of shitcoinery. And I kind of wonder from like a Bitcoin adoption standpoint, what is the biggest hurdle to the people right now who still call Bitcoin a scam? Is it the central banks and the politicians coming out and calling us what it is? Or is it the shitcoinery? Because I think the shitcoinery, it burns a lot of people.
Intellectual laziness. Okay, so let's talk about shitcoins first. They are essentially, in many cases, nothing more than an extension of the fiat Ponzi. Shitcoins have founders tokens, all of the problems that are evident in the fiat system to begin with. There's only one digital asset that solves the fiat Ponzi, that's Bitcoin. So focus on Bitcoin to solve the fiat Ponzi. Shitcoins, if you like NFTs or whatever, I'm not going to tell you not to own them. But just don't expect an NFT to solve the fiat Ponzi. Expect an NFT to be an extension of the fiat Ponzi in a lot of cases. And then going back to why central banks don't like Bitcoin, because they view it as a threat to their power, which it absolutely is. And why don't some investors like Bitcoin? Because they're intellectually lazy, or they've been brainwashed, or they're paid not to because they're like Charlie Munger and Warren Buffett, who own so many traditional finance institutional stocks like Bank of America and American Express, which are going to be disintermediated by Bitcoin. They don't want to see it succeed, very simply. So Charlie Munger has said Bitcoin is rat poison. I believe he's smarter than that. I know he knows that his American Express is a toll or a rent seeker, a toll charger on the fiat highway. And Bitcoin's going to disintermediate that. So he doesn't want to see that succeed. Now, if he truly believes it's rat poison, and maybe maybe fiat is the rat, who seeks advice from a 94-year-old man on technology anyway, okay? Like, the problems that these guys have, brought on the world from maintaining their interest in Coca-Cola and spreading sugared drinks across the world, don't always look at them as being the most ethical investors themselves either. So I got to call them out on that front. I think they are conflicted. I think they're giving very poor advice. And, time will take care of their investment views. It's just a matter of a ticking clock, okay? Charlie Munger shouldn't buy green bananas. I'm not sure if you understand what that means, but he should probably not buy green bananas, okay? Think about what I just said.
I don't know if it was you who said this once, but somebody said, like, Bitcoin is rat poison and Charlie Munger's the rat.
It could be, yeah, or I say Fiat's the rat, but yeah, yeah.
So you worked with 3IQ. They set up a Bitcoin ETF. Europe's got like an ETN or something. Australia's got it. The SEC is jawboning on it. Or not jawboning, but like they're resisting it, and they're saying, oh, it's because of these exchanges are unregulated. Gary Gensler, out of like anyone that's worked in the government, seems to understand Bitcoin. Like he taught a class on it. I listened to his lectures. What do you think his deal is? Why is he so against setting up a real spot Bitcoin ETF if he seems to understand what Bitcoin is? Is there someone pulling the strings? Like, what do you think's going on there?
No, clearly, I mean, the people that make his paycheck are the same as the Warren Buffetts of the world. Okay, you know, they view it as a threat to their coddled system. So nothing more than that.
So they'll let people gamble on the futures ETFs then, let them lose all their money there, right? Because of all the problems they have.
Well, don't forget that brings in an ability. Imagine this. I'm just going to pull on my tinfoil hat here. The United States can sell or just sell as much Bitcoin futures as they want to drive down the price of Bitcoin because it's settled as cash. It's not settled with Bitcoin.
Yeah, Lawrence Lepard talks a lot about this, how I think it's pretty reasonable to say that the price of gold has been suppressed through the futures market. Is there like a mechanic in Bitcoin that prevents that, or is Bitcoin also at risk of being suppressed?
Well, no. Okay, so Bitcoin can be suppressed from a futures market, but on the physical side, the problem with gold is some of it could be tungsten, right? Some of the gold that's sitting in Fort Knox or in a central bank could be tungsten, painted gold. And you don't know what the fixed supply of gold is because all the gold miners in the world, as I mentioned before, can change the supply of gold. So what does Bitcoin have going for it? Physical Bitcoin has fixed supply, no centralized authority, etc., etc., etc. All the things that make it better than gold.
One thing I wanted to ask you about, because you have co-founded lookingglass.edu, and there's some really great courses on this. A lot of the stuff that we talk about is like all these concepts should be taught in high school, and then the stuff that they're teaching in university, this Keynesian economic theory, a lot of this stuff is bullshit. When like, if in a perfect world, when do we start teaching people about money? Is it like in high school? Is it even as early as elementary school?
I think so. I think it's as young as possible. Now, one of the reasons they don't tell you the truth is if they told you the truth about the banking system, as Henry Ford said over 100 years ago, if the average American understood how the American banking system worked, there'd be a revolution in the morning. So they can't teach you that you shouldn't hold your money in a bank because of the risk. Then nobody would deposit their money in a bank, and then there'd be no a banking system, and capitalism is based on the banking system. So Looking Glass Education aims to tell the truth that you don't learn in high school because they can't tell you the truth. And it's a nonprofit platform. I'm very happy to be affiliated with that. It's run. One of the guys that runs it is a local Whistler guy. When I say local, you're local. Doing a great job. He's a 29-year-old kid, Sebastian Bunny, and he's doing God's work. I use that expression. He's doing amazing work for free to help people understand the truth about the global financial system.
I like to ask people this question because it's the biggest, I think, misconception about our entire monetary system, and that is that we need to have high inflation is bad, deflation is bad. We need to have a little bit of inflation. Everything needs to go up by 1 or 2% or nobody spends anything. Why is that a falsehood? Break it down for the people at home.
Okay, so as simple as I can, the commercial banking system, which does not hold a lot of collateral against the loans that they make, needs the price of that collateral to continue to increase to cover the value of the loan. That is why inflation is necessary for a banking system. Whereas, in fact, technology, as Jeff Booth points out, is inherently deflationary, but the inflation component is required to keep our banking system afloat. Under a Bitcoin standard, it would change dramatically. We're not at a Bitcoin standard yet, but we're working towards it. We'll see how it unfolds over time, but the simplest answer I can tell you, Julian, deflation in a capitalist commercial banking system will cause the banks to fail. That's why you need inflation, very simply. Once again, we get back to the whole banking system, this whole Henry Ford observation 100 years ago as to why a commercial bank is actually far more risky than the public understands. And that's because for every bank, they only hold about $6 of capital, risk-absorbing capital. The other $94 of a $100 loan is depositors' money. You see, it's the depositors that are funding the loan. And if you lose $6 on price of a loan, your bank goes bankrupt. And when you lose 75 cents on the price of the loan, like they lost in the Latin American crisis, you're so far underwater that the Fed has to come in with a rescue plan. So inflation helps to, buffer that reality. Because if the $6 of capital is in the form of a house and the house price goes up, well, the buffer increases on that loan. And it's all set as part of the capitalist system, if you will. Not easy to understand. We accept it because, they teach us in school not to worry about it. They don't teach you the truth. You gotta dig and peel a few layers of the onion to understand the reality.
Hey everyone, thanks so much for watching my interview with Greg Foss. If you enjoy Bitcoin and finance-related topics like this, whether it be interviews, documentaries, or short-form content, we're making this sort of thing on the Kinetic Finance channel every single week. And all you have to do is click subscribe down below so you can get notified when new videos come out. If you enjoyed this video and you want to see more content like this, please also consider giving the video a thumbs up, as it really helps it get out to more people as well. Thanks so much for tuning in, and I'll catch you in the next one.